Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest Reserve Bank announcement out, the latest monetary policy statement for February 2025. Hotly anticipated. It's been 3 months since we've officially heard from the Reserve Bank. They said back in November that it was a pretty strong signal that 50 basis points was the likely option in February, and they've continued through with that. They've cut the official cash rate by 50, down now to 3.75%. We're now lower than the Australian rate for the first time in quite a while, I think, which is a bit of a shift. But at the same time, the Reserve Bank effectively sort of shortening up their track, now expecting a little bit more of an interest rate cut than what they had sort of formally forecast back in November, expecting the official cash rate to be just about at 3% by the end of 2025. I think the official read is 3.1, which gives them about a 40% chance that they're sort of coming down to that position. But long story short, they've continued to sort of effectively now meet the market when it comes to interest rate expectations. Very much the right move. The forecast now is a lot more consistent with market expectations and everything else. Seems like a very sensible forecast all round.
Yeah, I mean, it does make life easy when you're trying to work out where the official cash rate is likely to go over the next few months. I mean, we had 2 more 25s penciled in before the middle of this year, and that now does seem to be very much on the cards. We've shifted, given the Reserve Bank's track, we've shifted and put another cut in the September quarter, taking it down to 3%, which of course is what the Reserve Bank thinks is neutral. So at that point, neither stimulating the economy nor contracting it. And that, I guess, kind of seems appropriate with their economic forecasts for growth going out, where they've got growth sitting somewhere in the order of around about 2.5% by the time you get into 2026. So yes, all around a pretty easily digestible statement. I mean, the risks they talked about, probably focusing a bit more, sort of downplaying some of the inflationary risks in the statement itself. They have headline inflation later this year. Previously, they were forecasting it popping up to 2.5%. They've lifted that to 2.7%, which makes sense again, given what we know about the evolution of some of the inflationary risks over the last 6 to 8 weeks, where we've had a sustained lower New Zealand dollar. We've had higher fuel prices. We've had a few more whispers about international price pressures as well, and sort of stickiness around inflation in the likes of the US too. So you put all of those together and you go, yeah, I can see there's more inflationary risks out into later this year. The Reserve Bank is saying, don't worry about those, they're temporary. And we've heard that line before, and it didn't end very well in 2021, but we are only at this stage talking about inflation, as I said, popping up to, in their forecast, 2.7%. And I think the comments from the governor following the statement itself and sort of subsequent interviews and at the press conference were more balanced, and we're saying, well, we could have inflation popping higher, we're keeping an eye on that. We could have economic growth that fails to recover quite as quickly as we're allowing for as well, because there's a whole lot of uncertainty, and certainly in the international economy, and just how the sort of whole geopolitical situation and trade situation and barriers all play out as well. So I think when you take both of those two risks out there, it does seem to be a sensible approach, a balanced approach from the Reserve Bank, and pretty clear indications of where they go to from here, which is a difference, I think, from what we've seen at times over the last 12 to 18 months. At the moment, doesn't look like there's too much scope for surprise going forward unless conditions do change substantially.
And that is, like you say, it is a bit of a change. Normally, the Reserve Bank isn't particularly explicit about what the actual next shifts are likely to be. You can infer what they are likely to be from looking at their track and similar. But last time, back in November, the governor was pretty strong in talking about a 50 bip cut and sort of saying that was the central case. And now in the February comments that he's made, he sort of said, look, 225s are the next two moves. And then after that, it's a bit more conditional, but the forecast track is sort of where it is. So we've got a pretty good guide now coming forward, and I think sort of a reasonable position. And you're right that when the governor has been speaking, and this is coming through in all of the conversations I think that people are hearing from the Reserve Bank recently, is that, look, they do have options out towards the end of this year. If they needed to move, if they needed to adjust, they can. They haven't made a rod for their own back, and they're sort of not starting from a continual surprise after surprise after surprise every time they look at monetary policy, which previously they were, and that was quite challenging. that point around where inflation could be towards the second half of this year, maybe popping up to 2.7. I mean, that's still within the target band. It's still between 1 to 3%. So for the Reserve Bank, no one is expecting inflation to pop back up to 5 or 7% or anything like that. But I think it was interesting as well that the Assistant Governor, Karen Silk, did say that, it's easier to respond to sort of shocks if you're a bit closer to the midpoint. You just sort of have more options. And I think Adrian Orr, as Governor, also sort of said, look, if we had to buy insurance, what way would we buy? What would we try and insure against at the moment? And there's just a bit too much uncertainty. So all of that's useful context. I guess the worry, and it's a worry, it's not an expectation, it's just a worry that we have as economists, at least here at Infometrics for the minute, is if you started to see inflationary pressures taking inflation back to 2.7%, again, not red alert alarm bells at that point, but if you're then starting to see economic activity crank back up, if you've got some of the interest rate cuts being made now that won't fully filter through into the economy for up to another year, all of that starts to raise the risk that you start to hit capacity pressures, and that little bit of additional growth after that could try and stimulate a bit more inflation rather than anything else. And so again, just that little bit of caution that there's maybe a little bit more heat left in the system and that things are turning around a bit quicker. There's a lot of water to go under the bridge. We saw some pretty immediate reactions, Gareth, from the banks in terms of interest rate changes. I mean, how much do we expect that all of that will influence the economy this year? I mean, it's pretty well signaled what's going to come through, but I mean, we're seeing some of the early signs, and you'd expect that if that continues, then we will start to see those better economic signs as the year moves forward.
Yeah, and I mean, I think the fact that the Reserve Bank has reasonably clearly signalled that sort of 3 more rate cuts is the central scenario, rather than the sort of slower path of cuts that they've previously been indicating, has given the banks a bit more room to move down the shorter end of the curve with those fixed mortgage rates. Prior to the statement, I've been thinking, maybe 5 to 15 basis points could be coming through in cuts. We've seen, I think, some larger ones. It's a bit patchy across the different banks, but there is a bit more pressure coming through in terms of those retail rates, and probably a bit more to come through as a sort of a degree of certainty about the path of the OCR later this year does start to increase, and banks go, okay, we can see where this is going. You're right, though, in terms of the sort of stimulus for the economy. There's a hell of a lot to come through yet. I think we've done the maths, and it's a sort of $45 million an extra a week back into household pockets between October last year and the end of this year, as people continue to roll off lower fixed rates. And I think this week's statement probably just increases the chances of that number being a bit bigger as well. You take that over the course of a year, you're talking $2 billion more, and it's around about 0.9 to 1% of household spending that could be boosted by that amount. So it's big. Add in the fact that the dairy payout is going to be maybe over $4 billion larger than it was last season. And I know not all of that filters through, of course, into sort of spending activity, certainly household spending, but it is more cash flow for farmers. It does help them to reduce debt levels as well. So and you look at high meat prices, I'm pretty optimistic, I think, about some of the sort of stimulus coming through into provincial economies as well. So there is more momentum building in the economy, and I think we're seeing early turning points in some of the data. It will continue to build later this year as well. So you're right, there's risks around the economy picking up and sort of getting a little bit ahead of what the Reserve Bank might be expecting yet, but nothing to the point where you'd be going, they're making mistakes now. We just hope that, when you do get to later this year, if they do need to be sort of responding to what's out there in 2026, that they're not sort of sitting on their hands for too long and going, oh, it'll be all right, the effects aren't that bad, and then realising that, in fact, things have got a bit away on them. But overall, at the moment, comfortable with where the bank is sitting, and comfortable that the economy is moving towards a better path of recovery.
Definitely. I mean, all that together, you've got a sort of better economic picture already. You've got the Reserve Bank that's sort of now a lot more in line with markets. So there's not sort of a big wide gulf like there was at points last year. Everything seems a lot more consistent and sort of consistently better over time. The economy, certainly, we're not chucking it into fifth gear immediately, but you've got to go from reverse to neutral first, and then hopefully into first gear as we head through the year. So again, that momentum warming up, but not sort of too quickly, hopefully, to overcook things. But if it does come through, there's room to maneuver for the Reserve Bank and an ability to adjust. We'll assess all of that going forward, what the Reserve Bank does next, what it means for interest rates, and how it all filters through into the broader economy on one of our future editions of Econ Talks.